There's a fire sale at Evergrande as they miss yet another bond payment. Why crude is the one commodity you should be watching. And are Fed tightening cycles actually bond bullish? Answer those questions more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today. And it seemed like we might have been able to escape a week without talking about Evergrande again. And yet here they are back in the news, missing a bond payment. And I want to explain to you why this matters, because it's not just a company that has missed one payment or two payments. They're not technically in default. They're in delinquency right now. But why does this matter? Because if you think about, if you're in the US and you think about going back, or anywhere in the world, back to the great financial crisis, what happened when there started to be problems in the banking system? People lose confidence. Now think about this. You're in China, you want to buy a property, and the biggest property developer is missing his payments. Are you going to want to go out and buy from them? Probably not. Are you going to want to buy from someone else? Maybe not, because you don't know if they're next. Now, what about from the bank's perspective? Do you think the banks are going to want to lend to Evergrande? Maybe even lend to other companies? Because what have we learned so far? That an auditor effectively left out some really important information during its last audit. And well, perhaps the banks might be nervous that other auditing companies left key information out from other companies' reports. And then you go to the next level, is not just, will existing lenders not want to lend, but they might start wanting their money back. And that is a problem, because a system, a debt-based system where there's loans going out, requires confidence on both sides that the borrower is going to go out and borrow money and do things with it to get more money back and pay those loans back. It creates confidence. When banks get nervous, they start asking for their money back. And that will hurt a cash-strapped company as it is. And then you look at the banking's perspective, as credit downgrades hit them, what do they have to do? Well, they have to hold more collateral against this debt that's gone bad, because that's what the rules say they have to do. And then if all else fails, you get a default. We know what defaults do to the banking system. It destroys them. Of course, the big risk is Evergrande a one-off? I'm not convinced it is, but let's go into the story now that you have an even deeper understanding why this matters, because again, Evergrande could be the first domino to fall in what could be many, many more, and it may not be limited to China. So here we go. Back a couple days, the PBOC, the People's Bank of China, vows to ensure healthy property market with this Evergrande update. Yeah, you bet they do. China Evergrande Group is facing a fresh dollar bond interest payment test on Wednesday, less than a week after it missed an initial deadline to deliver the coupon on another offshore note. So the developer's list of debt obligations may be getting longer after some holders maintained it's a guarantor of a separate $260 million bond that matures on Sunday. So we have one that came up on Wednesday, and we have another one coming Sunday. The investors are forming a committee, I love this, to press their claims in case the note, which was issued by a joint venture of the company's key onshore unit, goes into default. So what you're hearing here is people are trying to get in front of the line. They want their money back. So they want to say, hey, look, you owe me first, so I have rights to your money. That's what they're worried about. And then again, you start to see how this problem escalates. And in the latest asset disposal, again, the fire sale at Evergrande, as they're forced to raise cash, it is poised to lose control of its most valuable financial unit as it agreed to further cut its stake in Xinjiang Bank, raising $1.5 billion by selling shares of the regional lender to a state-owned firm in northeastern China. Now, what is not in this article, but is certainly worth noting, is the bank said, by the way, now that you sold your stake, we want our money back. You owe us some money, and we want to be paid first. We want to be paid now. So again, it just adds to the story of banks get nervous. There's money hitting the account for Evergrande, and the bank at me says, hey, pay us back. Let's continue on, see where this goes. And then on Wednesday, what happens? Evergrande defaulted on the second offshore bond after a $1.5 billion bank sale. So they had money. Isn't that great? They had some money and couldn't make a payment. Now, again, think of this as you're an investor, or perhaps someone who wants to go buy property, that this company sold a $1.5 billion stake and couldn't make their debt payment. Now, why is this going to be a problem potentially for other countries and China is the dollar. And here we zip over to TradingView and we look at the trade weighted dollar, DXY, and you can see it's breaking above a range here of 94 that suggests the dollar is going to get up here into this $97 range. Now, why does the dollar matter? Why should you be watching the dollar? Because as the dollar goes up in value, the debt service cost to Evergrande goes up with it. And not just the companies in China that borrowed in dollars, anywhere else in the world, that becomes a problem because the dollar is the global reserve currency. Let's continue on. So let's look here now as bondholders await payment, marathon buying. All right, so here we go. 2 holders of China Evergrande dollar bonds with a coupon due Wednesday said they haven't received payment. We know that. Evergrande owes $45.2 million in interest on the note due in 2024, according to data compiled by Bloomberg. But fortunately, there's a 30-day grace period. So they're in grace, they're in delinquency right now, before a default could be, keep in mind, could be declared. The lender could choose not to let it go into default. The developer is also facing claims as a guarantor on a separate $260 million bond that matures on Sunday. And so there you start to see the mounting problem. As we already talked about, it sold off its position in that bank. And now China shows up and says, wait a minute, we maybe need to bail them out a little bit. And China says, hey, state-backed firms, state-backed meaning government firms, pick up Evergrande assets. So start buying their stuff because they need money. So Beijing is prodding government-owned firms and state-backed property developers to purchase some of the embattled China Evergrande Group's assets, people with knowledge of the matter said. Evergrande is saddled with $305 billion in liabilities, is teetering on the brink of collapse, but the central government is unlikely to intervene directly, interesting, to resolve Evergrande's crisis in the form of a bailout. According to 6 people, 4 being in government and regulatory bodies. Authorities are hoping, however, that asset purchases will ward off or at least mitigate any social unrest that could occur if Evergrande were to suffer a messy collapse. They did not wish to be declined. So here you have the other part of the story now is the government is not willing to intervene directly, but what they can do is say, look, they can direct state-owned companies, go buy their assets, so they'll have some money, and maybe they'll start paying on the debt, hopefully, which so far they're not. And if they do, that will inspire some confidence, and maybe this whole problem will settle and go away once Evergrande has some money in the bank. So far, not happening. But of course, when we talk about debt problems, how can we omit the United States from this? As, of course, we now know there still is a problem with the debt ceiling not being passed. The GOP says no, and the new Democratic move on debt. Now, why does this matter? Because Treasury Secretary Janet Yellen, former Fed chair, said the Treasury is set to run out of cash around October 18th. And why is that a problem? Is because you're probably seeing this reaction in the bond market. Yields are going up. The bond market's starting to say there could be a default, even though in history there's never been one. And this will probably go down to the wire. And maybe it'll just get kicked down the road a little bit. And in fact, that looks like what we're about to see is the Senate Democrats ditch effort to link funding bill to debt limit. That's what the Republicans wanted. And what is the latest talk now that they will try to pass something later today or tomorrow and try to kick the can down to December 3rd, where they will go at this again. But remember, this is what the Republicans wanted. They did not want those two linked. And so why did we see the bond market sell off potentially? Liquidity. People need liquidity. They're concerned about a default, so they want to raise cash. And what do? They go out and sell the part of the curve they don't want to, the long end, and they're selling it. So likely as this gets resolved, we should see interest rates come back down. Now, does that mean that the Fed will stop their plans, or at least their suggestions that they're going to tighten? Well, maybe, because another thing showed up this week, and that is 2 Fed leaders, Eric Rosengren and Robert Kaplan, decided to resign over a trading controversy because they were trading while they were busy bailing out the world and the U.S. by trading against the information they knew. That's generally considered a big no-no, although according to the Fed, they were following in the rules. But rather than have an inquiry, they both decided to resign. Now, why might that matter a little bit is because they're both hawkish. They were both wanting to raise rates. They both believed in that. And it's possible that they could be replaced with some doves who might want to continue the policies that Fed Chair Powell has maintained, which is easy monetary policy. But even if not, even if the Fed does go through with this, doesn't mean that interest rates are going up. Well, let's take a look, because it may not. And here's a great piece from various central banks, Haver Analytics, and Deutsche Bank. And what we see is hikes in the dark blue and cuts in the light blue. And here it's netted out that from starting in about late 2009, early 2010, on net, central bankers raised rates going all the way through into we'll just say late 2012 or early to mid 2012. So let's take a look at 30-year Treasury yields and let's find late 2009. So here's this. And what did we see? Rates went up because people, of course, assumed that when the Fed hikes, that means rates must go up. They don't understand that it wasn't necessarily the Fed raising rates, tapering. And then what happened? Boom, rates went down. Now, why did that happen? Because there is a whole point where less support of the bond market from the Fed, higher interest rates, actually lead to tighter financial conditions because people aren't interested in borrowing at those rates. And if new money is not created through lending, then ultimately rates must fall. So what are we seeing today is huge, massive bets, again, that rates are going to go up. And yet history has proven over and over and over again, and we've talked about it, that's still the most likely direction for rates is to go lower, because if they go higher and they're not backed by lending growth, which we haven't seen, we'll maybe talk about that on Friday, then you're going to get lower rates. All right, let's head into the economic data. We got to still talk about crude, which is pretty important. I really want you to understand why crude is the commodity that I've got my eye on right now. Retail inventories in the U.S. in August were up. Preliminary wholesale inventories up, so 0.6 on retail, 1.2 on wholesale. As we continue to hear about an inventory shortage, these numbers continue to go up every month. Home prices going off the charts again in July, up 1.4%, pricing out so many people. Year over year, up 19.2%, creating a massive bubble. Let's talk about the Conference Board Consumer Confidence Survey, and for that, we'll head over to the Conference Board website. And what did we learn? The consumer confidence dropped in September as the spread of Delta variant continued to dampen optimism, said Lynn Franco, the Senior Director of Economic Indicators at Conference Board. Concerns about the state of the economy and short-term growth prospects deepened, while spending intentions for homes. Listen, spending intentions for homes, autos, and all major appliances all retreated again. So confidence in spending money went down. Short-term inflation concerns eased somewhat, but remained elevated. Consumer confidence is still high by historical levels, enough to support further growth in the near term, but the index has now fallen 19.6 points from the recent peak, and these back-to-back declines suggest consumers have grown more cautious and are likely to curtail spending going forward. Now, why does this matter? We've talked about this. As consumer confidence goes down, what does that mean for the stock market? Stocks usually go down because people spend less money, companies have less revenue, less profits, and they've got a lot of debt. And what does it mean for interest rates? Well, interest rates go down. Why? To, again, get people excited about borrowing. Maybe they're not excited about borrowing now because they're concerned about the economy. Rates go low enough, they go, well, at these rates, I can't go wrong. And again, that's why you see such a high degree of relationship between consumer confidence, stock prices, and Treasury yields. In fact, here you can see the overall consumer confidence, present situation, and expectations all trending down. We've seen the University of Michigan survey indicating that these levels are even likely lower than that. All right, let's continue on to the Richmond Fed Manufacturing Index, because this red-hot manufacturing sector, well, is going the other way. Now, the way you read these is each signal equals the percentage of responding firms reporting an increase minus the percentage reporting a decrease. So we see 1% of firms now showing shipments are heading lower. Volume of new orders on net, 19% of firms saying that is heading lower. These are from positive numbers. See how the numbers in July were big, and in August they were coming down, and now look at September, you see a lot of negative. Backlog of orders, fewer firms reporting, 12% of firms recording an increase there. Capacity utilization, 5% on net, 5% of firms decrease. Vendor lead time slowing. Local business conditions still in contraction. Capital expenditures slowing. Finished good inventories. 14% of firms saying that their inventories are shrinking. So now look at this number of employees. So you see the factory sector slowing down, but look at the number of employees. 20% of firms hired more people. 41% raised wages. But check this out: prices paid, $14.01 year over year. Prices received went down $9.13 year over year. And so what do you think is likely to happen with the number of employees and wages if these other numbers that are minus don't start turning back up? You probably can guess where they're headed. All right, now let's get into today's data before we get into the crude oil. And what are we seeing? Some inflation now starting to pick up in the Eurozone. Preliminary Spanish CPI up 0.8% year over year at 4. Now remember, the Eurozone wants inflation. What's the easiest way they could get it? A higher dollar, right? I mean, they don't have to do anything. They just need to get the dollar to go higher. How do you get the dollar to go higher? Well, you start tapering your asset purchases and hope the Fed doesn't follow you. And sure enough, that seems to be working. Let's continue on to today's data in the U.S. Mortgage applications down 1.1%, but still trending higher, just on the week down. And then we get into pending home sales shooting higher at 8.1%, but year over year still in the minus territory. And now we're into crude oil. This is the one thing that I really want you to be watching is crude oil inventories, because what do you see here? 4.578 million barrel build. Now, this could be a one-off report. We've seen draws after draws, and the expectation was for a draw. How about gasoline inventories? Up 193,000, so not a big increase. Distillates up 385,000 barrels, but overall, we're still below 5-year trends, broadly speaking. Now, why does crude really matter? Because it's really linked to stock prices, and it's also linked to Treasury yields. It's also linked to inflation. Let's take a look at this, because I really want you to understand why I'm watching crude more than anything. Now, you'll notice in the past, I pulled up the S&P 500 on the FRED database, and you can do this with your charting program. I just wanted to use the FRED database, so if you don't have a charting program that you like, you can go here for free. And you'll notice that crude prices and the stock market weren't broadly linked. I mean, crude prices went down and the stock market still chugged higher until finally it had enough. But then look, after 2016, you'll notice they're starting to move almost together and up and down. You can see it happening. So what we're seeing in crude now is inventory building. Now, why would the dollar matter here? Because if the dollar goes up, well, that tells you what direction crude prices are going. They're going down. And if crude is going down, well, what does that likely suggest for stock prices? Well, it suggests that the stock market is likely to struggle here, because every time crude gets, you see this top part here, this is about $75 a barrel. Every time it gets up in the $75 range, financial conditions get tight because energy prices are too high, and they both come down. And then it gets up here just above 60, and then we have the pandemic. And now we're back up here in the $75 price range. And what's happening? Financial conditions are tightening because consumers are having to spend more money on energy costs, and that is less money for everything else. It tightens financial conditions. So some people say, well, higher crude's got to be inflationary. It is if people have increasing wages and money to afford it. If they don't, it does the opposite. Now, what about yields? Let's take a look at Treasury yields here. And now we're overlaying 30-year yields. And what do we find? The big declines in crude lead to big declines in yield. And you can broadly see that when crude oil prices are rising in blue, yields can fall. There's times where they'll hold steady, and then when crude lets go, they collapse down. And then you can see crude goes on kind of this extended increase here again, and then it starts to head down and bottoms right around the time yields do. Now crude oil is back up at that $75 level where it's too tight, and everyone thinks yields are going up. The correct answer is if crude gives up here, if it turns out it is tightening financial conditions, it means crude and yields are headed lower. And of course, we already know if you look at the year-over-year traded change on consumer price index and you overlay crude, you know that crude prices in blue coming down mean that consumer prices are also coming down with it. So anyways, keep an eye on crude. That's the one I'm watching. We'll see if Congress gets around to passing a debt ceiling and that takes the pressure off of Treasury yields. I kind of have a hunch it will, but we'll see. We'll see you back on Friday. Thanks for watching. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell security, financial instrument, or participate in particular trading strategies. Video was prepared by Steven Van Metre, personal capacity. Opinions expressed as value and do not reflect the view of Atlas Funded Advising or Steven Van Metre Financial.